Hi, my name is Kimberly, this is Quentin, and this is Emily. Today we'll be doing our market view presentation. This presentation is going to demonstrate a market view of the exchange rate pairs between the Australian dollar and the US dollar, and between the euro and the Australian dollar. We'll be doing this by conducting an analysis of the future strengths of each currency respectively. The Australian dollar has one official user and three unofficial users. Its currency is controlled by the Reserve Bank of Australia. The US dollar has more than 10 users and more than 40 unofficial users. Its currency is controlled by the Federal Reserve of the United States. The US is considered the strongest economy in the world, hence why the currency is often used as the term of other currencies in the foreign exchange market. The euro's official user is within the Eurozone. There are 19 of the 28 member states of the European Union who uses this currency. The currency is controlled by the European Central Bank. It is considered the second most widely held reserve currency after the US dollar and the second strongest currency after the British pound.
The interest rate is basically determined by the equilibrium of supply and demand of a currency in the foreign exchange market. There are several factors that affect the exchange rate, but we're going to talk about three for today. So first, we look at the relative inflation rate. A nation with an increase in inflation rate will experience less demand for export, which lead to decrease in demand for its currency, and also more demand for import, which lead to increased supply for its currency. Potentially, we look at decrease in exchange rate. This inversely will happen to a nation with a decreasing inflation rate, which potentially the exchange rate will increase. The US inflation rate is currently at 1.7%. The Federal Reserve of America also decided to keep it around 2% for the long run as well. If we look at the federal government policy, which to impose increased domestic production and reduce import in order to decrease unemployment rates, according to the US Bureau of Labor Statistics, this projection of inflation rate may fall over the next 3 to 6 months and it will rise afterward. And the Australian inflation rate is currently at 1.9%, which the Reserve Bank agreed to keep it around 2 to 3% for the long run to serve as an anchor to the private sector. So in 3 to 6 months, we look at the weak position of AUD against other currencies. And the Eurozone inflation rate is currently at 1.5%, which is higher than the expectation according to CNBC report. The European Central Banks also target at 2% as well by the end of 2017. But the staff of European Central Bank projected that the inflation rate will decline to 1.2% in 2018 and it will rise to 1.8% in 2019. So in 3 to 6 months, we look at the increasing in inflation rate and it will decline, which position euro to the stronger position. So the projection for the exchange rate for AUD and USD based on a relative decrease in inflation rate in the US comparing to Australia, we can see a decreasing in exchange rate based on the decrease in demand for AUD and increase in supply for AUD. And similarly to Euro and AUD, the exchange rate will increase on the basis that a relative decrease in inflation rate in the Eurozone compared to Australia, which an increase in demand for Euro and a decreased demand for supply for Euro.
So now I'm going to talk about the relative interest rate and how it will affect the exchange rate and the money demand for our local economy. So in this slide, we can see an increasing in relative interest rate will increase the exchange rate of local currency and will cause a rise in capital inflow of the local economy. Due to the rise, money demand rises and hence shifting the demand curve to the right. Next, we'll talk about the decreasing in relative interest rate. And you can see the decrease will cause a decrease in exchange rate of local currency and will reduce the capital outflow of the local economy. When it is reduced, money demand reduces as well, causes the demand curve to shift to the left. Now we're going to see the interest rate of Australia. As based on the graph, we can see the nominal interest rate of Australia is at a steady rate of 1.5% and the real interest rate is at negative 0.4%. And based on the assumption, the strength of Australian dollar will remain unchanged and will slowly pick up over the coming years. Next, the interest rate of the US. As we can see on the graph above, nominal interest rate of US is at 1.25% and its real interest rate is at a negative 0.4%. And based on the assumption, US dollar will definitely show strength in the foreign exchange market. Lastly, we're going to talk about is the interest rate of the euro. And based on the graph above, we can see the nominal interest rate is at 0% and the real interest rate is at negative 1.5%. And it is expected that euro will not be as strong as it is currently in a foreign exchange market over the next 12 months. So, in conclusion, we can see that against Australian to US dollar, it will decrease overall as US dollar will rise in strength, and based on euro to Australian dollar, it will remain unchanged or slightly change, or there will be a slight change because the change in interest rate for both currencies are almost similar. So in conclusion, we conclude that the US dollar and the euro will appreciate more over the coming years.
The forecast showed that there is a relative decrease in interest rate in Australia comparing to the US. So potentially we will see the lower exchange rate in the futures on the basis that decrease in demand for AUD and increased supply for AUD. Also, what happened to the euro will be the relative increase in interest rate in the Eurozone comparing to Australia. Potentially we will see an increase in exchange rate between these two currencies. On the basis of that increase in demand for the euro and also decreased supply for the euro.
Another factor that influences the change in currency is looking at the relative economic growth of the country. There are two side effects to the exchange rate when we're looking at the growth. An increase in economic growth would lead to an increase in demand for imports, which eventually increases the supply of the currency, which causes a depreciation. The second side effect is an increase in economic growth leads to an increase in the level of overseas borrowing, which meaning the domestic investments are increasing from overseas, which will lead to an increase in demand for currency, which would cause an appreciation. Now, when we're looking at Australia's economic growth outlook graph, the August growth of Australian economy is at negative 0.19%, but it is projected to increase to no more than 2.75% by the end of the quarter, according to Bill Evans, the chief economist of Westpac Co. He also stated that Westpac is currently forecasting the growth of 2.5% in 2018 within the Westpac MI leading index. However, the ASB shows that the import of goods and services have ultimately fallen by 1%, consumption goods fell by 2%, non-monetary gold fell by 17%. Now, what we're essentially seeing is imports of goods and services has fallen. This is contradicting the first side effect, so we'll be focusing on the second side effect, where foreign investments are being injected into Australia. The latest updated overseas investment into Australia by the Australian Department of Foreign Affairs and Trade shows that the United States have fallen by 1.9% from 2015 to the last year, which should have positioned Australia's currency to depreciate. Nonetheless, according to the Financial Review, the American tech giant Amazon is going to enter the Australian online market, which will bring a huge capital into Australia. Hence, the private sector anticipates that the demand of Australian dollars will increase. But based on the assumption of economic growth, eventually it will position itself in the future. Therefore, theoretically, Australian dollars will still depreciate. And the net inflow of capital to the US has decreased based on the ABS report released in May 10, 2016. The flow of funds from European countries now using euros into Australia has increased substantially between 2014 and 2016, but the flow of capital between Australia and the Eurozone was negative, or net outflow by the end of 2016, according to the Deputy Governor of RBA, Guy Bell, which supports the assumption of the side effect of the shift in economic growth will position Australian dollars yet again at a weak position for lowering the demand of Australian dollars.
Essentially, we will see the second side effects as the decline in net capital inflow into Australia from the US, which will push the demand curve of AUD to the left, therefore the exchange rate will be lower. And also, the euro will be the surplus in the net capital inflow into the eurozone from Australia, which pushed the demand curve to the right, therefore the exchange rate will be higher. So in the conclusion, we will go long for the US dollar as the US will appreciate against AUD in the future. And also the euro was against AUD will go long for euro as the euro will appreciate against USAUD. And all the data, you can find all the data within this link, and I also provided through the description below as well.